Hello folks, this is the Inner Circle Trader, or as many of you know, Michael Huddleston. We're going to be looking at the idea of trading with 90% setups, and I know that probably sounds very ambitious as a goal in teaching in the framework of one particular video, but I'm going to lay that challenge before myself, and let's see if we can accomplish that in about an hour or so. Um, but before we get into the specifics on how you actually go into the marketplace and ferreting out these 90% setups, it's important that you understand that there is a huge advantage to your trading if you go into your learning with low level objectives. Okay, don't go in there thinking you're trying to double your account in a month, or even 6 months, or you know getting crazy returns like 30, 50% per month. I think that 6% is an ambitious goal for a monthly return for a new trader. And I think that if proper study and amount of time over price action study, not trading, study, okay, and understanding the framework of the concepts that I teach, most of which you can find on the innercircletrader.com. A lot of the tutorials that I have on that website and on my YouTube channel, there's a plethora of information already available, and I know most of you are waiting for the crowning jewels of my Market Maker concept series, volume 9, 10, 11, and 12. This is kind of have a little bit of some of the flavor you'll see in those videos, but I took a lot of specifics out of that entire collection of the last portion of that series and kind of like threw it together for a lot of folks that are asking me, can you give me something that I can work with right now? And that is in a way using majority of the concepts I've shared over the last 5 years or plus in the FX community, and how to frame an idea on going into the charts, going into the equity plans that would be necessary for a new trader to adhere to, or at least work within, and then grow and graduate into higher, loftier goals. Now, it doesn't mean you're always going to hit these goals, obviously, because past performance is not indicative of future results. And everything I'm showing you here is not to say there's any account that's ever done this. Okay, we're speaking in the realm of theory. Okay, so while these ideas are theoretically possible, they're not theoretically guaranteed. Okay, so I want you to understand that. But if you don't have a target, okay, and you're aiming at nothing, you're going to hit it every time. So we're going to start with a low objective. Okay, and I know some of you would, you know, argue with me saying that 6% return is a pretty ambitious return. If you're used to seeing the results that your fund manager does with your stock accounts, if you have IRA in the States or whatever, that's a really good return. And the idea that they teach in equities is if you can return an average of 12% per year, man, 12% a year is absolutely doable. Why people invest their money in those types of accounts and not simply learn how to manage their own money is beyond me. But that's another discussion, another rabbit trail for another video. Okay, so we're going to look at the idea of just trading with 1.5% risk. Okay, and yes, that's kind of high if you're a new trader. So if you're a new trader, okay, even in a demo account, do not trade with 2%, 5%, 10%, or anything like that. You should be trading about a half of 1% and maybe even a quarter of 1%. And the purpose of that is not to get lulled into believing the demo account profits and losses that you take, they won't have any emotional effect on you. Okay, you'll be able to look at the results in a pure uh, analytical fashion where you're not being tug of war fashion, internally and psychologically. Even though it's monopoly money, it's pretend, it's not making you any money when you're in a demo account. If you're starting as a new trader, it's important that you use the tool of the demo account to frame your development step by step by step to the point where you graduate to seeing consistently profitable in terms of pips. Okay, this being harvested from your trade selections and your timing and your exitings. Okay, so if you're doing all the steps properly, you're not going to be looking for money initially, and I'm talking the first 6 months. And I know a lot of folks are just not, they're not patient enough. Okay, but I've beat you over the head for the last 5 years. You're going to be patient with me, or you're just going to leave. And most of you stuck around, and I congratulate you. Well done. Okay, so the patience factor really is a millionaire maker. Okay, and if you don't have patience, you're going to lose. Okay, and I guarantee that you're not going to make money consistently. You might have a flash in the pan success story. Okay, but keep doing it and you'll lose. Promise you, it's going to happen. So, how do we identify low hanging fruit in terms of returns that are very achievable and realistic in the foreign exchange market? Once you understand the framework of your specific trading style, and that trading style may be a position trader, it may be a swing trader, a day trader, a scalper even, looking for 15, 20, 30 pips intraday, a couple times a week or even one time a week. Okay, I'm going to build the idea that you only need that one type of setup. So if you are a scalper, okay, and you just can't get yourself in front of the charts a whole lot, or you're limited to doing mobile phone trading, like you have to trade on your phone or whatever, we're going to give you an idea in this particular video on how you can do that. So I'm giving you the lowest rung in terms of opportunities that are available, and you can form fit this to meet any goal that you have in mind in terms of style of trader. Okay, now I want you to remember some of the points I've made over the years as it relates to pips. On a weekly basis, if you bring in an average of 25 to 30 pips, okay. Now, if you're trading 2%, if you risk 2% of your account and you average a 23 and a half, I think it's 23 and a half to 25 pips per week, your money, if you're consistently doing that, you will double your money, a little bit more than double your money every single year. Now, I guarantee you, your stock retirement account did not do that last year. Okay. Um, and some of you will probably send me an email, oh yeah, mine did, but you're lying. So the point is the equities market, you have so many things against you, okay, because the leverage is not there, okay, and most of the companies that you would be looking to trade in that have numbers to support buying them are so lofty in price. Coming in with an account like $2,000, what are you going to do with that? You're trading Apple. I'm long, Apple from 120, looking for 135 and 140 presently at the time of this recording. I just got 130, but think about it, $130 per share. How many shares can you buy of Apple with $2,000? I'd argue not many. Okay, so, and yes, I know some of you say, well, I can buy options, and I know that. Okay, I'm not trying to get into an argument. Okay, but I'm trying to give you an idea on how lucrative the foreign exchange market is. And here's the benefit that most people overlook: the risk management is absolutely perfect. It's perfect because it allows you to form fit and tailor made your specific risk model. You can't do that in futures. You can't do that in trading equities. You're limited to what the option will allow you to. Buying of an option, put or call, gives you the right but not obligation to own 100 shares per option, or you buy the shares. That's your limitation. Period. Done. If you ain't got the bankroll, hit the road, Jack. You ain't got an opportunity to trade in the equity market, okay? Or you go into a fund and you add money to it each week and hope the guy that's managing your account is looking out for your best interest. But I can tell you, they're not. Okay, so they're not. So it's important that you understand that the main framework that we're building in this particular uh, video teaching is, if you want to be trading with 90% setups, part of that equation comes along with it managing your equity properly. Okay, because I can show you how to buy and sell all day long in wonderful setups. Okay, but if you manage your money wrong, or incorrectly rather, um, you're gonna get knocked on your tail side, and it's not gonna be fun. And you're gonna walk away, really disturbed, thinking, man, I got a system that makes money. It's highly successful, but if you over leverage your account, it doesn't take much to dust it, and you're out of the game. Okay, unless you want to refund your account, and most people won't refund the account as many times as that type of show will require you to do it, because eventually you'll be out on a limb, sawing yourself off the tree, on the wrong side of the limb. So with all that, let's get right into the business of how to trade with 90% setups. We're going to assume you have a hypothetical $2,000 starting equity. Now, I took a lot of time to argue with myself what would be a realistic account size to start with. If you're really looking to make a go of it in Forex, can you trade with less? Yes. Should you? No. Okay, but looking at this, okay, if we were going to assume that we're trading with a $2,000 account, and we're risking 1.5% per trade. Now, this is assuming that you've gone through the 6 months trial and error of going through all my videos, going through, not watching videos for 6 months, but going through all of them and then starting a demo account campaign where you're utilizing the setups, looking at a demo account, risking 1/4 to 1/2 of 1% in the demo account, okay, and only using the amount of money that you would have in your account. Just because they give you $50,000, don't trade with $50,000 leverage. Assume only the $2,000 that you're going to put in. It may be 5,000, maybe whatever it is, but sticking to the example we have here, we're going to assume that you're trading with a $2,000 account. Only risking 1/4 or 1/2 of that account size, because you do not want to get lulled into believing that that money is so easy to make. Okay, so therefore I'm going to add more risk on, because if I can do it 80% of the time or 90% of the time, like we're trying to convey in this teaching, 90% success is going to come with time. Okay, you're not going to come out the gate with 90% accuracy. Trust me, it doesn't work like that. But how do you aspire and then grow to and develop to 90% setups and consistently making those types of setups? This is the framework. Okay. Now there's a lot of other avenues you can go to get the same result. Okay, or different tools out of my collection and my arsenal, and arrive at other style of trading and still get the basic result of 90% success. Okay, so it's all the same way, just different avenues using the approaches and concepts together, but blending them so it fits your unique trading profile, both psychological and emotional and financial, because you can't spend my money and I can't spend yours. So it doesn't make a difference what anybody says is the perfect starting equity account, okay, size. Whatever you can afford to trade with, that's what you start with. Because as much as everybody would like to have 50,000 to start with, most people can't. Okay, so what does that mean if you're trading 1.5% risk? Okay, well, every trade from the 2,000 point here, okay, you're going to be risking $1 per pip. Now that's under the assumption that you're using a 30 pip stop loss. Now, if you've been watching my material, you know that I like 30 pips because it's 1/3 of the typical average daily range of 100 pips. Now, I know they're not always average daily range of 100 pips. I know that. Okay, but I more or less, general rule of thumb, if you want one of those types of things, that's what I look at average daily range as in the major fiber and cable pair. I look at that as that's like a good benchmark. Now, again, it's going to deviate. You'll have big ranges and smaller ranges, okay, but over a long period of time, I believe that 100 pips is pretty fair. So approximately 1/3 of that daily range is 30 pips. So now, I've already taught many times in most of my teaching series and some of my webinars, live sessions and such, and commentary and forums. Um, if you are looking to be long, you want to be looking to go long below the opening price. And if you're familiar with the Asian range, you want to be buying below the Asian range high. Okay, and if you do not take notes in this video, you're not going to retain it. And that's why I'm insisting you have a notepad, because I'm not going to print it out for you. I'm not going to type it out because it's going to save me a lot of time. Plus, it'll force you to do what I did. Take notes, lots of them. Read them in your own handwriting, okay? By writing them down, you'll also retain them better. So again, if you're looking for bullish scenarios and looking to be buying, okay, the idea is you want to be buying below the Asian range high and below the opening price. Now, what is the opening price? Opening price is at 0 GMT, okay, and 12 midnight New York time. Now, I said it like that because a lot of guys will ask, well, what about daylight savings time? Okay, well, just simply do this. Set yourself a clock, okay, for New York time. And whenever New York time does its shift in daylight savings time and back to standard, you'll know. So whatever that opening price is at midnight, use that one, okay? I'll just kill a whole lot of arguments and email questions and Twitter questions like that. Just use 0 GMT, the opening price there, and then the opening price at 12 midnight in New York. Okay. Now you're probably saying, well, which one is it, Mike? Is it the one at 0 GMT or is it the one at 12 midnight? Now, gun to my head, I generally want to look at midnight in New York time. Okay, I like that one more. It's more apt to show the Judas swing that everyone's grown to understand with my teaching. The 0 GMT That one is, I believe, a lot more sensitive with yen, Aussie, New Zealand, those types of pairs, because they're more prone to make sizable moves in the Asian session. But they still are very sensitive to the 12 midnight candles opening price as well. Again, it's 12 midnight New York time. So when I say ICT time, I know a lot of guys will rib me and say, well, that means if it's going to take 30 minutes, it's going to take 4 hours. What I mean, really, without any jest behind it, when I say ICT time, just simply whatever it is in New York, in states, that's my ICT time. Okay, so just bear that in mind. But if you're looking to be a seller, you want to be selling above the Asian range low, and you want to be selling above the opening price of both of those opening price points we just talked about, 0 GMT and 12 midnight. Okay, now if you want to be a buyer, okay, if you want to be a buyer in the market, the best days to be buying is Tuesdays and Wednesdays. Okay, if you want to be a seller, best days are Tuesdays and Wednesdays. Why is that? Because there is a large, and we'll talk more about this in a little bit, there's a large likelihood and probability for the weekly range to expand from the early beginning of the week, okay, Monday, Tuesday, and certainly by Wednesday if it's been lagging. And that's how you know if it's going to be a Wednesday buy, because if Monday and Tuesday are lackluster and it's overall still bullish, the signal is going to generate on Wednesday, London Open. Okay, and the same things we just discussed are true. Just reverse it for looking to be a seller. Okay. Now, what amplifies that magnitude of accuracy to 90%? Well, if you understand the higher time frame premise, which we're going to talk about with charts, and we'll show you some examples on how to build that framework, you'll want to be looking at those higher level key support levels, higher level time frame order blocks, and liquidity pools. Okay, those are the pillars of higher time frame analysis, and then incorporating momentum studies when it's conducive for those types of trading scenarios. That would be a further amplification, and put you even beyond the 90% likelihood of results. So yes, you can trade with a higher degree than 90%. You will never trade perfectly. Okay, I'm wildly accurate, but it took me a long, long time to get here. But I still do lose, and I lose a lot of opportunities because of my entry point not being exactly where it should be. I try to get too fancy around trying to get the lower low and the higher high, and sometimes I miss opportunities. So I take that as a loss. Okay, as a trader, I didn't lose any equity, but I take that as a loss because I did not perform efficiently there, because I allowed greed. And honesty, what'll be is I'll refer back to what I did, and I was either looking to be greedy, or I was allowing my ego to to drive me into trying to get an entry or exit price that was not as realistic as I should have expected. So now that's what we're getting into later on. I know I'm going. I probably should have been talking with the charts in front of me when I was doing all this, but we're going to go back over all that stuff again shortly in the second half of this video. But for now, I just want to cover the boring part. The numbers suggest here, if we're risking 1.5% on a $2,000 account with a 30 pip stop, and I'm going back to this now. The reason why we use the 30 pip stop is because the likelihood of price gyrating up, above, and below the opening price 30 pips, with before it takes its direction, assuming that's for sake of argument, say we're bullish on the cable, which is British Pound USD. We see the opening price drops down, okay, from the opening price. Generally, it does not do that more than 30 pips. Now, can it do it 40? Yeah, but typically it's about it. If it's going to be an up close day, and it's going to be higher than it opens at midnight or at 0 GMT for that particular day, and it is a Tuesday and Wednesday, or Tuesday or Wednesday, the probabilities for that trade, okay, to move below the opening price more than 30, that's the general rule, okay, but it can go as much as 40 pips. 30 pips is about the cusp of where the low will form below the opening price. Don't take my word on it, study it, okay, and I'm telling you, you're going to be floored, absolutely floored with the statistics behind it all. So looking at that, just with that alone, you can turn the video off and you're already in a 9% club if you put time and effort in studying. And I know it sounds egotistical. I know it sounds, it can't be that easy, but it is. It absolutely is that easy. What makes it hard is you're not going to trust it. Why don't you trust it? Because you haven't put the time in front of the chart, seeing it consistently over and over and over and over again. Will it sometimes fail? Absolutely. And that's why we said 90%, not 100. Okay. In those 10% of losses, you can undermine your entire growth of your equity, just by goofing off and over leveraging, okay, or not doing what you're supposed to do, okay, not trying to wait for it to go into an order block, not waiting for a kill zone or time of day where it's highly likely to create a swing back into a retracement where it allows you to see that momentum expansion, okay. So if we're trading with that mindset, okay, and 30 pips is the reason why we elect that, is because we don't expect too much volatility above and below the opening price beyond 30 pips. Um, if we are looking for a simple one-to-one and we're developing as a trader, we don't know how to trust the 2-to-1, 3-to-1, 4-to-1, and so forth setups. Okay, you just want to look to make the same amount of money you put up on the table in terms of risk. Well, if you're trading with 1.5%, okay, you're going to see a gain of a weekly goal of 30 pips. Okay, so you're going to look to make 30 pips, risking 30 pips. And by doing that on a weekly basis, okay, and 30 pips is really, really low end, you would generate 6% per month. Now, 6% per month, okay, in 1 year is again more than $10,000. Oops, I just discovered something. And there's no way I'm going to go back and fix this. Should have been looking at this right here, this 5,000. Let's do this. It's 2,000. This is a real, real big goof up, but guess what? It just shows I'm human. All right, let's not do that. Let's do let's do the $2,000 here, okay? And you can see in 1 year it'll be $4,024. Okay, $4,024. And in case you guys, I know some of you probably were looking at that number like, wait a minute, how do you get that? Well, the starting count again would be $2,000 here, and then you dropping down into over 3 years, you'd be at $16,000. If you never do anything more, you never added anything in terms of equity management and increasing your your exposure. The the same thing we said earlier. It's $1 per pip. It's 30 pips stop, risking 1.5% maximum. Then again, assuming that we have already went through all the development stages and we've gone through all the videos, we know what we're looking at, and then now you're applying it. Okay, in a demo account setting, you it will teach you what to expect. Okay, numbers wise with this gearing. Now, when I say gearing, it means you're risking only 1.5% with 30 pip stop, the static stop of 30 pips. Now, eventually you'll get to be able to trade where you'll trade smaller 30 pip stops, but that's not the goal of this teaching. But goal for the week is 30 pips. And again, that is absolutely doable. Okay. Now, over time, once you are consistently able to grab 30 pips from the market on a weekly basis, and you can do this with just one pair, one, not 14, not all the majors, okay, just one pair. Pick one pair and study it. Get to know it very, very closely. Each pair has its own individual characteristics and personalities. You have to learn what they are. I can write them down on a list, but you're not going to respect them until you see it happening over and over again. Okay, so once we get to the point where we consistently do that, the next graduation would be to do what? Anticipate 2-to-1. Well, the stop's going to stay static. We're never going to risk more than 30 pips. Will you get stopped out if it goes 40? Yes. What do you do about it? Continue on. Don't worry about it. Don't harp on it. Learn from it. The next setup, gearing, would be you're going to be looking for 60 pips per week. You're going to look for 2-to-1 setups. Okay? And you're going to see that really all you're doing is teaching yourself to hold the winners longer. Trust me, it's not easy. In the beginning, you're not going to want to hold it. You're going to want to get out when it shows 29 pips because you're going to think they're going to pull the rug out from underneath you. At 29, you'll never see 30. Okay, yeah, it'll still happen some days. Guess what? It's gonna happen years from now. Still, you'll expect to see price hit a particular target where your limit is, and it just gets within a fraction of it, and you don't get out. Okay, and that's all part of trading. It's because it's an imperfect world. But if we have the gearing set to trading 2-to-1 setups, in other words, we're making two for every $1 risked, okay, and because we're trading with a 30 pip stop, the gearing will look like this. We're going to trade with an expectation of 12% per month return. The goal now is 60 pips. The risk is still limited to 30 pips. Well, assuming that in 1 year, we can see clearly that it's much more in terms of return, okay, than we saw with what we saw at 6% return, as you would expect. And you'd be over $118,000 in the course of 3 years. Now, why am I using 3 years? Because 3 years is about what it's going to take once you really warm up to it. Now, mind you, you got 6 months of, pre-study time behind you in addition to the 36 months, 3-year time period. Okay. So it's not going to be overnight success for you. And a lot of guys that sell courses and teach you things and write books, they don't tell you that. And that's the truth. You're going to have to grow into this, regardless of how good the system is and how good your mentor is and how good I am and whatever. Okay, it's going to take some time. And every doctor that goes to medical school aren't right that way out their graduation going out there and cutting on people. Okay, they got to do some things before they just start doing that. So without having any greater discussion as it relates to that, once you get to the point where you can graduate, and now if we can learn to anticipate a buying day and we can get in near the low of the day, and if we can hold on to a trade with the likelihood of it expanding, okay, with the goal in mind that it would be a higher close on Thursday and Friday than it did when it opened up on Monday or Sunday, okay, so we'll have an up close week. If you allow your trade, if you have really good placement on a Tuesday or Wednesday, you could see a 3-to-1 payout. The stop stays at what, 30 pips risk. Are we increasing our risk? No, it's remaining at 1.5%. Watch this. 18%. And I know some of you are chuckling like, man, if I could just get 18% one time, a year, that'd be awesome. Well, it's going to take time to get here, but you're looking at 30 risk to get 90 pips returned. Okay, so your $2,000 starting here, okay, in 1 year would grow to $14,575. In 3 years, it would grow to $750,000. Okay. Now again, this is not taking into account for taxation. This is assuming that you try to trade a tax deferred account. Now I know you may not have the luxury of being able to do that, but um, I'm sorry if you don't. But you you have to consider obviously any form of taxation wherever you're at in the world. But this is what it would look like with 3-to-1 gearing. Now, eventually, eventually, if you get to the point at which you can now consistently nail down one shot, one kill setups, okay, that's assuming that you're trading long Tuesday and or Wednesday, holding to Thursday's close or sometime in Friday, exiting, you can many times see 4-to-1 payouts. And 4-to-1 payouts would put you in a very, very elite status in terms of monthly returns. 120 pips for the week. 30 pip stop is the same. It doesn't change. $2,000 will become $26,000 in 1 year. And you don't need to describe how these numbers change your life either. The the idea obviously is for you to, number one, go in with a very small low end range objective, 30 pips per week using a 30 pip stop. Build a comfort zone with using those individual initial gearings. Okay, once you get to the point where it becomes so easy for you to go in and get 30 pips, and we're going to talk about how to do that in a couple minutes, the next graduation is okay, well, now you got to learn, okay, to hold on to the trade to a degree where it allows you to get 2-to-1 payouts. And you're going to learn that the only thing that's taking place is the setups that I'm teaching you, they're there all the time, but your ability to hold on to the trade will not always be there. You'll see something in the chart that scares you, something will be said by me on Twitter, okay, or I won't like your tweet, okay, and it'll psychologically affect your trade, and you'll get out way too early. Okay, or if you see me take some profits on a position, on Twitter, which is really why I don't like doing that, because I know a lot of you are just hanging on a thread waiting to see what I'm going to say. If someone puts a tweet in, and it's close to what you're doing, um, what's my opinion about that? And I'm really, I don't like those types of things until the week closes. And it's not because I don't want to like something that looks stupid. It's I don't want to influence anyone's trading, because my job as a mentor is not to show you how much money I can make. That's not my goal. My goal is to show you how to trade using what I know as a trader. And then I'm watching, engaging what you do. Okay. And if I'm an influence adversely, or positively to your outcome, while you're in a trade, you're not learning anything except for a dependence on me, and I don't want that. You want a complete independence from me and everyone else outside of your own trading. You're your own island, okay? And you need to be an island in this industry, okay? And that is a benefit, okay? And you need to take great comfort in that and learn to like being in isolation from everyone else. You don't want everybody else doing what you're doing, okay? Because it goes without saying. You just want to be an independent thinker, okay? So now, with all that, okay, and I really wish I would have paid more attention to this cell on the spreadsheet, but whatever. The point is we see the numbers here. $2,000 eventually, even with a small amount of money, okay. I'll give you a hypothetical here. Say you start with $2,000, okay, and you invested and you learned and you did the 2-to-1 gearing for about a year. Okay, and then it took a little bit over a year for you to get to the point where you're paying out 3-to-1 setups. Okay, you're not taking 15 trades per week, guys. Either. Okay, you're going to see that there's only a handful, maybe 2 or 3 tops, okay, setups that you're going to take for the week, and that's it. You're going to sit on your hands. That's it. You're not in there trying to out trade the guy next to you because he did 20. You're only looking for the choice setups, the cherry, okay, the cream of the crop. You want the best, okay, and that's what a trader does. We don't like to get in there a whole lot. We don't like a lot of frequency. Okay, the more you trade, the more likely you're going to take a loss. I don't like losing. So that's a trait that I'm hopefully instilling upon all of you is I have a disdain for losing. I hate it. I absolutely loathe it. Now, you can say that's egotistical. No, I am pursuing excellence, and I need to have that as my goal. Because if I consistently do that, the byproduct is excellence. And it may not be perfection, but I'm way ahead of the pack in terms of what everyone else is doing and what everyone is expecting to do. Okay, so these are the numbers. This is what we build the millionaire mindset with this. The frame a 90% success rate. You start low, you build you up to a next grade of 2-to-1 setup, then 3-to-1 setup, and then 4-to-1. And then obviously, if you're trading with a higher time frame premise, okay, you can use these setups to pay out, 8 to 10, 12, 15, you know, to 1. And that's long-term position trading, which we are not teaching here, but you'll learn that in the latter portions of the Market Maker series. But you can really do a whole lot better than what we're showing here and not trade a whole lot. So you don't need to have a day trader's mindset. And you'll learn all that. But for now, I'm just trying to stimulate your thought process as it relates to trading with a high degree of accuracy and still utilizing some of the equity management concepts that I teach. So let's go over to the charts and start looking at what it is technically we do with all this boring stuff and how to apply it to the charts and how we can move towards 90% setups. Okay, guys, we are looking at a crude diagram, I know, but it's a lot of information on this chart, and I'm going to have to kind of like spell it out for you and kind of decipher it for you. But again, it's meant for you to um, draw your own notes from my dialogue and some of the things that we're going to talk about with this. It's very easy for you guys to screen capture. Just take a control. I think it's print screen. I'm not sure what you're using in terms of computers, but if you do a screen capture of the chart or diagram right here and use it for your notes, um, you can draw all kinds of notations on it as well. But what I want to talk about is it's going to be limited to a sell scenario in this diagram because I didn't take the time to reverse all this to show you everything for a buy side, but we're going to show examples in the chart. That's why I went with this example, because it'll give you a contrast between what it looks like graphically for sell scenarios and then we're going to show you in the charts buying scenarios because of what we did last week in Twitter and what we anticipated, at the low recently in fiber and cable. So again, the way I learned charting, it came from my mentor, um, Larry Williams. He was the first one that really had a major installment to my understanding of price action. It didn't stop there. Obviously, I went on to learn a greater degree of price action analysis, and um, I certainly am thankful for what I learned from Larry. But just like you're learning with me, I don't know when you're watching these videos. I mean, it could be 30 years from the time I actually made them, and there may be some new information. If you've only stuck with what I'm teaching, I mean, there's going to be something else that's, greater understanding, I'm sure, that will be revealed by some other party or some other entity. But as it relates right now, you're looking at the best of the best. Okay, so looking at the chart here, this is all basically the same information. Okay, and I'm showing you more or less an evolution on how I internalized price action and how I saw on an institutional price level, um, when I was in that realm where you're seeing the banks doing this, and when you're seeing the large institutions doing this, and you're actually being able to see when they're doing their action of getting in and getting out. Okay, and then having what I knew in price action of looking at charts, it became so clear what was going on. It was like the veil parted right then and there. So I'm probably the only one that's uniquely in this position where I've been first a what you would consider a uh, nobody in terms of trading. I mean, I started grassroots, man. I'm talking like really, really nothing. I mean, I had no idea what I was doing at all. And it's amazing how my life took all the turns where it did that lead me to where I'm at today. Because if you would have told me when I was a kid I was going to be doing this, I would have laughed at you and said, there's no way. But the way I learned trading and understood price action was on this format right here, open, high, low, close. Now, I still favor this, okay, in terms of understanding where price is going to be going either on an intraday basis or even a higher time frame basis. Because my eyes are not as strong as they used to be because I stare at charts all the time. I put a lot of time in, sometimes as much as 13 hours a day. In my earlier 6 or 7 years, I was just way too much time in the charts. I think I did more damage to myself than good. But the same information we see with an open, a small little rally up, a large range down, making the low of the day, and a close off the low. This is your typical down close day, okay, or distribution day. What my mentor would teach, and I may not, I don't know. We'll see at the end of this production around editing time, if I'm going to include an example of something that like Larry Williams teaches. If not, I'll share it in either a Twitter series of a couple tweets that way. But so don't hold me to it. Okay, they may not be installed in this particular teaching, but in Twitter or some of the forums that I haunt, I'll throw a couple of those things up. And again, it's not to kick the lights out from underneath my mentor. I'm not trying to be disrespectful. I'm just showing you, don't stop learning. Don't ever stop learning. You're always going to learn regardless if you get new material, but you need to always be flexible and allow yourself to learn. And if I hadn't done that, I would have been probably unsuccessful trading. I'll be honest and tell you that. But Larry Williams gave me the framework, with the idea that he put out there in a teaching session, that he said that the buyer, I'm sorry, the sellers above the opening price, he wished he knew these people up here. Well, he wishes he knew us because that's what we teach. We've been teaching it for 5 years and in foreign exchange markets. Okay, and I've been trading it since officially I've been trading it since 2002. That's when it became known to me. Um, how exactly I was looking for it consistently. I had hints of knowing what to look for before that, but it was like anything else. It was like I thought it was an aberration where it once in a while it worked, and then once I just sat down with folks that were actually doing the institutional bank trading, and they told me what they're doing with the real orders. then it was very clear, what was missing in Larry's understanding is he didn't know what the point of this little move was for, and that's to trip pending orders, lull buyers into the marketplace, and it also is mainly is to seek the liquidity to allow the shorts to come in before this long range starts to unfold. So my mentor Larry would require, okay, about 20% maybe. I think if my memory serves me correctly, about 20% of the average daily range, he would subtract that. Okay, in other words, say it's 100 pips for daily range average. He would take 20 pips. Not that he traded forex, okay, because if you really read anything he says, he doesn't like foreign exchange because he thinks that overcoming a spread is ridiculous. He would rather pay a commission. I would rather pay the spread because I know how to overcome it quickly. But nonetheless, um, we're going to say that here's the opening price, and say the average daily range is 100 pips. And again, we're not going to argue the case there, but we're going to use that as the assumption. 20 pips below the opening price, he'll sell there. Now, to me, that doesn't make any sense. In retrospect, it made absolutely no sense once I learned what I'm teaching you, because this could retrace back up to the Asian range low or the opening price and create an additional selling point. Why would you open yourself up to all of that needless risk? Okay, so what we teach is that we want to sell when it's rallying at the beginning of the day or intraday sometime. Okay, you want to be selling when it rallies. Why? Because it's returning back to a known area of selling pressure, i.e. a bearish order block, i.e. a mitigation block. That's it. Okay. So now we are not selling on weakness. We're selling on strength because we understand that the strength is most likely false. It's a suspect rally. That's why we dubbed this the Judas swing. The initial rally up from the opening. Okay. That's the fake out to make everyone believe, okay, that's going to keep going higher, because it usually happens in a real quick, sharp movement. But it's only moving sharply because there's no orders there, and they're going to pair up the orders up to which we can't see here, but above the opening price there may be a bearish order block or a mitigation block up there, okay, or a liquidity pool at which they reach up into to take stops. That's all there is, guys. Write that on your notepad right now. To go short, you're only looking for an area of liquidity. That means a liquidity pool. What's going to work in that scenario? A turtle soup sell, okay? Or if you're familiar with Larry Williams, I'm sorry, if you're familiar with Chris Lori, his riptide reversal, very similar to the turtle soup pattern that's found in Street Smart's book. Okay, that pattern works wonderful in that regard. Or you can look for the price to trade up into a bearish order block on a higher time frame. Okay, or run a previous day's high. Okay, or return to a previous day's low. Or we trade up into a mitigation block. Okay, maybe this was an area at which on a longer term price swing, price has moved down, and this allowed it to move up into an area where they saw an earlier buying opportunity that didn't pan out, and now it returned to that area. Okay, so there's some trader remorse there. Okay, that's it. There's your scenarios. That's all you ever need. Those four scenarios, okay, that's what sets up the primer for a down move. And it doesn't matter what time frame you're trading. It could be intraday like we're talking here, or it could be on a weekly basis. It can be on a monthly basis. Okay, and obviously the higher time frame you go, the more magnitude of the price move in large terms of pips will be acquired and harvested by those payouts. But the idea is we look for the opening price when it's bearish. And when is it bearish? Well, the highest probabilities are when we are looking at higher time frame, monthly, weekly, daily, and 4-hour order blocks bearishly, key resistance levels that are converging with mitigation blocks. Okay, optimal trade entries, converging with those types of things, and liquidity pools where the obvious trend is still down, but it hasn't had a retracement in a while. So what are they going to reach for? They're going to reach for the stops because they want to get new buyers in to get short against. They're going to pair orders to allow the buyers to get tripped into the marketplace, and then they're going to be selling right into that rally. for the next new leg priced lower. Okay, and I know some of you are maybe watching this for the first time and didn't see my other video series, and you're still scratching your head saying this doesn't make any sense. This is too vague, Michael. It is vague. It's vague for you because you haven't gone through all the other stuff. But if you've gone through my other stuff, everything I'm saying to you now makes absolute sense to you. You know what I'm talking about now, and we have common language. So don't be discouraged if you're watching this video without having an understanding of the things I'm discussing, because it's all in the videos I've already presented. Okay, so if you haven't gone through that, please don't send me tweets. What is this and what is that? I'm just going to be upset and send you a tweet and say, please go to the videos that's on my tutorial page. Okay, because I understand everybody wants to get to the front of the line, but it doesn't work with me. Okay, so with all respect, obviously, but just understand that I'm put a lot of work into the videos. I'm expecting you to put a lot of work into learning it, and it costs you nothing but the time. And I'll let you argue whether or not it's worth it or not. But the opening price and the rally up, okay, and then down close, this little move here, the low to the close, this price action, I'm going to tell you exactly when it happens. You ready? Write this down. And this is all ICT time, New York time. 10 o'clock in the morning to 12 noon. 75% of the time, that's when this low is formed, okay, and then you have the close. What's the close? Well, I look at the close as 1900 GMT. That's the close of the day. Now, the last little bit of when it doesn't make the low, say it continues going lower and it's going lower past midday, like noon, and it's still dropping, making fresh lows. It will make the low between 1800 and 1900 GMT, that hour. At 1900 hours, boom, that's the end of the day. Now, why am I saying that? Because remember, there's FOMC minutes and announcements that come out 2 o'clock in the afternoon in New York time. That's why we use it. So now you know when to anticipate that late in the day factor. But generally, 70% of the time, between 10 o'clock in the morning to noon, this is when that low is formed. All this price action below the close is happening, or basically the low of the day is between 10 o'clock in the morning and noon, New York time. There you go. Okay. When is the high of the day forming? Between 2 o'clock and 4 o'clock in the morning, New York time. Now think about this, guys. If we're bearish based on the moving averages, say they're stacking and they're going lower on a daily chart, okay, and the 4 hours moved up into an area of bearishness, and they've just recently left a bearish order block, and now you're expecting what to happen? Range expansion to the lower downside. Okay, when you anticipate the lower price objectives, that's below price. Okay, so a support level that price may be reaching for. If you are looking at higher time frame price charts like the monthly, weekly, daily, and 4 hour, in that vein, in other words, looking for price trading to lower levels that it's not trading to now, what that does internally, or it should be doing for you, is saying, okay, well, price should be reaching lower on a higher time frame price chart, so I shouldn't be shaken out with intraday rallying. I should look at that as what? Selling opportunities. And when you couple that with bearish order blocks, mitigation blocks, optimal trade entries, and turtle soups with liquidity pool raids, boom, it's over. End the game. That's it. Game over. Done. It's a lock. You know exactly what you're doing. You know the script. You know what the players are doing, and you're just waiting for your time to get in there and do what they're supposed to be doing. If they're going to be looking to sell, you want to be on the back. That's it. Simple as that. Now, graphically, what we see in charting mostly in my work now, because it's easy for me to describe and show and see, and it's easier on my eyes. The same thing in this candle is the same thing as depicted in the open, high, low, close. The opening price is here. It makes that little wick higher here. Okay, and then you have this big range down. It makes the low that you see here. Then it comes up and closes here. The same information here is what you see here. But teaching wise, I like this style here because it gives you a graphic depiction of what it is that's going on internally. The opening price, the false rally, everyone gets thinking, okay, it's bullish. I'm not thinking that. You're not thinking that if we're in a bearish model. Okay, and then price slams down and it extends until when? Between 10 o'clock and noon. Most of the time you'll see it by 11 o'clock in the morning. Okay, but by noon, London's, they're closing shop, everyone's going home, there it is. Okay, but the bulk of the move is between 2 o'clock in the morning and 10 o'clock in the morning. That's the bulk of the daily range. Now, don't take my word for it. This is the point of this video. Start marking off 2 o'clock in the morning New York time and 10 o'clock in the morning New York time. And you tell me if that's not the bulk of the daily ranges. Now, yes, you can go to websites and everyone talks about the trading sessions. Oh, that's common knowledge, Michael. But what have you done with it? Think about it. We all know when London starts. We all know when Asia starts. We all know when New York starts. But how's it happen to increase your profitability? No one, we're ever learning but never coming to the knowledge of the truth. Okay, so the bottom line is I'm giving you what you've never seen given in one shot. I'm doing it right here. So now we're going to take it one step further. How are you going to internalize this market event that you would anticipate seeing? Okay, because again, we're assuming this is a daily range. Okay, I'm not sure if I said that earlier, but that's what this is depicting a theoretical down day. Okay, this is a daily bar. And this is a daily candle. Okay, graphically, what you would anticipate seeing is this: the opening price, which is the same price at the top of the candle's body, and the opening price, the left tick of the open, high, low, close bar. The opening price, we understand what that opening is. Okay, it's majority of the time it's going to be midnight time in New York, but it can be, if your pairs are Asia sensitive, it can be 0 GMT. We're going to see and expect a rally from that opening price up. Now, how much of a rally would we anticipate? An average of 30 pips or less, okay? So now, what do you do with that information? You can actually take the opening price. As soon as you see the opening price at midnight, well, Michael, I can't be up at that time and trade London. You don't need to. You don't need to do that. All you need is the opening price here, okay, and add 30 pips to it, whatever that 30 pips is. Then go back over in the left side of your chart and find, is there any confluence inside of the 30 pips from the opening price up to the highest point, which the range of 30 pips would be added to the opening price. Is there a confluence of a mitigation block, a bearish order block, or would that raid any key previous day's intraday high or daily high? Think. The scenarios we talked about that leads up to the Judas swing over here when we were talking about this bar, that's what you apply here. Okay, it's limited to 30 pips. Now, there will be days where it only goes up 8 or 9 pips, and then it takes off. Okay, that will be missed opportunities a lot of times for folks that want to set and forget a limit order sell, okay, and then go back to bed and wake up for their 9 to 5 job in the States or wherever they work. But for those guys that want to be awake and watch it real time, which is even if you do it one day per week, if you just invest a little bit of lost sleep, on Tuesdays and Wednesdays, the dividends that it pays, guys, I cannot tell you. It's amazing what you learn by seeing it real time. It's one thing seeing it on the chart after it's happened, in the morning after, but when you're seeing it live, you learn a whole lot because you'll see why it looks so exciting to the retail world, and they're really seeing this rally up like this real quick, and it makes you think, oh man, it's taken off. I want to join in. Yeah, you do. You want to look to sell into that. Okay, so you'll sell into it and you'll look to obtain the London high. And again, we understand that usually is between 2 o'clock and 4 o'clock in the morning, New York time. But it can happen as early as 1 a.m. and as late as 5 a.m. Okay, but by far and large, if you just look between 2 o'clock and 4 o'clock in the morning, with this event taking place here, rallying up no more than 30 pips average into a previous order block that's bearish, a previous mitigation block, an area where it would run a previous short-term high where stops would be clearly being trailed if it's been moving lower. Okay, and we understand that the opening price is not going to see 30 pips, 50 pips, and then up here 60 pips and then go lower. It doesn't happen like that. Okay, can it happen on some weird news? Yeah, but it doesn't happen as a steady diet. And again, I'm telling you to do not trust what I'm saying. I want you to look at the charts and prove if I'm saying what I'm saying is true. And you're going to clearly see that this is light years ahead of everything else. Because what is it doing? It's telling you what to do, when to do it, how to do it, and why it works. That's every question every moment wants when they buy a book or a course and they go to a seminar. But how many are walking out of there after the purchase, reading the book or the seminar, feeling that they got what they went in there looking for? I can tell you I've wasted a lot of time and money with things that looked really good and shiny, and the opportunity was well sold, okay, but when I got in there, it didn't deliver. Okay, so Hopefully, I mean, this is some real high-end stuff here, okay? But if you don't take the effort of looking at it and studying it, you won't appreciate it at all, and you won't see it for how good it really is. Now, you're probably looking up here at this box, okay? And what I'm utilizing this for is think of the day as a tank of gas, okay? Or I guess a better analogy would be a battery, okay? So at the beginning of the day, at the opening price, we're going to say, just for the sake of argument, we're going to stick to the midnight candles opening price in New York. Okay, yes, you could use the 0 GMT, but for now, just for instance, we're going to use it from 12 midnight candles opening price. The battery is now full. We have a full battery, okay, and that means the time of day or the duration of what volatility that will take place for that particular day is, it has that much time value, or not value, but time duration in it. Okay, and we view around noontime, generally noontime, as the end of the day, and that would be depicted by the right side of this box here, and the beginning of the box is denoting the full battery or full tank of gas that would deplete over time. So as London happens, we've only depleted a small portion. We have all this uh, uh, a battery or tank of gas for any volatility that would take place for that day. We still have time for all those things to take place. And then we get down to when the price would expand, go lower, okay, there will be a small little retracement between 5 o'clock in the morning and 7 a.m. Now think about what I just told you, okay? There's going to be a small retracement, and this is all ICT time, New York time. There will be a small retracement generally between 5 a.m. to 7 a.m. generally. Okay, and in that retracement, and it can go as late as 8 in the morning sometimes, because there's maybe some news announcements, maybe some effects happening in the bond market, okay, that may have to be factored in. So I guess really the rule would be 5 a.m. to 8 a.m. Okay, but really be sensitive to 5 to 7 a.m. that retracement into the range that had started from London. Okay, now at that time we have about a little bit less than half of the daily battery used up. Okay, I'm sorry, more than half of the battery used up. We have less than half of the daily range's um, lifespan left. What that means is you'll see an acceleration in New York to make its move faster, okay, than you see what happens in London. And what is it moving towards? It's moving to go down into an area of anticipated value. Now, value can come in a lot of different forms. It can come in the form of a higher time frame support level, which we're not noting here, but can be. Okay, it could be the average daily range. Now, what's the average daily range? We use a 5-day average daily range, and there's an indicator that I use to calculate that. I am not going into the mathematics to arrive at that, but nonetheless, it's a quick, easy, it's an application I apply to MT4, and you can, you know, understand now why I like MT4, because really it's the average daily range tool that I use for it, and it gives me my basis of where I look to see the ADR for that day. Not that I'm trading with MT4 with my live accounts, but nonetheless, you know why I still hold true and loyal to MT4, because really outside of that, it's a very archaic um, trading platform, but it's still nonetheless it's a good teaching platform. But the New York session, okay, will retrace up into around that 7 o'clock to 8 o'clock in the morning time frame. Okay, so now we've now mapped out times for all these things. Okay, when's the last time you read a book, okay, or listened to some guy talking about, supply and demand or anything like that, to tell you exactly when to anticipate those things? Because it's one thing to show a chart and say, okay, here's a supply level, here's a demand level, and we're going to expect this or that. I'm telling you when it's going to happen. I'm telling you exactly when it's going to happen, and it repeats all the time. All the time. The key is to get these 90% setups, okay? If you're looking for this scenario, when the higher time frame charts suggest it, and we're going to look at some of those in a moment, when it suggests the idea of to anticipate this type of event, then it's like, man, it literally is like walking up to a tree and just pulling fruit off and just enjoying yourself, but not gorging yourself, okay? Don't run in to that tree and wind yourself before you get there, because you won't be able to enjoy it once you get there. You'll be too far out of breath to actually pick the fruit and enjoy it. Okay, so again, don't rush and don't gorge. Okay, that means don't trade before the setups actually come, and don't risk more than you should. Okay, the low down here, again, we identified that between 10 o'clock and noon New York time. That's what this little bounce will be. And then the market will do what? It'll go sideways. It doesn't stop trading, it just goes sideways until we get to the new day around between 5 o'clock, 6 o'clock in the morning, 5 to 6 o'clock in the evening New York time. We start the new day, and it starts doing its thing again in Asia. Okay, we've just mapped out graphically what the day looks like when it's a down day. We identified the times of the day and what those times of the day are important for. Now, let's go back to the idea of 30 pips. If we risked 30 pips, okay, initially up here, say there was a bearish order block above this opening price, about 20 pips above it, okay, we could risk going in with a limit order, selling short at whatever particular price that would be denoted by the order block, which we don't have here, but we're under the assumption there's something that's bearish up here. Price would rally above the opening price as we would anticipate, not chase. We would anticipate this happening. Then when we see it happening, it's fitting the script that we would have internalized in our idea of what we would expect for a down day. Well, it's above the opening price. We'd go sell short right there. Okay, now if we sold short 20 pips above the opening price and we're going to risk 30, watch what's going on. Here's 20 pips above the opening price plus 30 more from that price point. That's outside the scope of a traditional price swing on a down day. When the opening price opens, it's not going to go 50 pips higher, then go lower 300 pips. Generally, it won't do it. Okay, it won't do that. Can it happen sometimes? Absolutely. Will you take a loss eventually when it does do that? Absolutely. It's going to happen. Promise. I guarantee it's going to happen. And you're going to remember me telling you it's going to happen. But you should remember also, by far and large, statistically, you're going to see it's not happening that much. So, can you weather getting punched in the face or punched in the gut or have yourself tripped up or lose a little bit of money? Because how much are we losing? 1.5%. If you can't weather 1.5% loss, turn this video off. Don't ever trade. Don't ever do it. Don't ever even consider it, because you're going to take a loss. Absolutely guaranteed you're going to happen. And period. It's end of story. Done. You're going to have a loss. Now, because I promised you you're going to take a loss, you shouldn't be scared that it's going to happen. You should anticipate it's limited to 1.5%. And you anticipate that you have a system that will show you trade setups that will ferret out winning scenarios that far outweigh the losers that you will incur, because you're going to incur losses, guaranteed. Okay, but how big will your wins be initially? If you sell up here, sell up here with 30 pips stop above it, essentially theoretically that would be, in that example, 50 pips away from the opening price. The likelihood of the opening price and then seeing 50 pips up then down close is highly unlikely. Highly unlikely. London usually reaches up about 20-30 pips, runs a previous stop, or goes into an order block, or into a key level of resistance, and then you see the dive. Okay, so if you're trading up here short, does it have to go all the way down here to get your 30 pips? No. It doesn't even have to make the low in New York to get your 30 pips. Wow, think about that. You can make 30 pips without actually spending a whole lot of time in the marketplace, and surgically make surgical strikes, knowing when to get in, where to get out. Okay, and I'm telling you, don't skip over saying, well, I know how to trade day trading now, Mike. I'm not going to do the 1-to-1. I'm not going to do that. I'm just going to look for my 3-to-1 and 4-to-1 and 5-1. Don't do that. You're going to do a huge disservice to yourself. Trust me when I tell you that. Learn to crawl before you walk, because you're never going to run to those higher level returns monthly without learning first to crawl. You are not going to have the foundation. And I know there's going to be a large degree of you guys are just plugging your ears right now, but I'm telling you, you will not make millions of dollars. Think about what I'm telling you. You will not make millions of dollars trying to get ahead of the line. It won't happen. I tried that game. Trust me, when I had to do it all over again, start all over with a fresh mindset, it did not take long. It doesn't take long for you to actually see the fruits of your labor. Okay. And trust me, don't you really want to know beyond a shadow of a doubt what you're doing works and you're comfortable with it and you know it intimately? That's the benefit of doing that setup of looking for one-to-one initially. Again, it's not about making the money initially when you're first learning these concepts. If you're just watching my stuff to try to make a lot of money right from the start, forget it. You're going to lose. And you'll blame me saying my stuff is full of crap. But it's you that's being lazy. You need to apply the time and go through the drills and go through the exercises because that's what teaches you. It's not me sending Twitter account setups or giving you levels or giving you videos. Okay, it's you applying the concepts and tools, okay, correctly over time and seeing when they're not working for you and understanding why you saw it like this and why you saw it like that. And when it really starts to gel with you and you internalize it, then that's it. No one's ever going to shake you. Nobody. Then it's safe for you to go in the forums because you can go in there and say this guy's full of crap. He don't know what he's talking about. Okay, he's not going to convince me. I don't know what I'm doing. There ain't one person out there in the world that's going to tell me I don't know what I'm doing. I know exactly what I'm doing. And I can talk to people that can say they've been doing it longer than I have. My mentor's been doing it twice as long as I have, more than twice. Okay, but I'm honestly convinced in my heart that I can trade better than him. Did I take $10,000 to $2 million in a year? Yes, I said $2 million because that's exactly what he did in 1987. Got hurt a little bit and closed it out for 1.2 million. But the average margin for the S&P back then was really, really, really low. It was extremely, extremely low. I guarantee he couldn't do it now. So bottom line is this. You're going to be a better trader than me if you do these things. And I'm okay with that. In fact, I'm excited because that's the whole reason why I'm asking all you guys to learn it and then keep in contact with me. I'm not selling you any of this stuff. I didn't sell any of this. I could sell this. I guarantee you, I could sell this for a lot of money and I would probably get a lot of money sent to me. But I don't want to deal with billing and all that stuff. I don't care about all that. What I want to see is the life-changing effect that it has. And I want to know how you guys develop. Because I know somebody that's listening to my voice now is going to outdo me. And that's what I'm doing this for. I'm not the guy doing videos and trying to look down on everybody saying, look at me up on my throne. That's not what this is. I'm trying to lift you guys up to go higher than I have. Because I'm telling you, what I've done is just a little scratch in the surface of what's capable for someone that started like me, a very young man. If I would have known this stuff right now, what I knew, and everybody can say this about everything, but I'm telling you, if I knew this when I first started, oh man, you would have known about me everywhere. It would have been everywhere. I would have been in books, and people would have trust me because that's how crazy it was. It was like a carnival like circus, man, on America Online. They knew me, and it has exploded. Now it's not about me, it's about everyone else. And I'm interested. Honestly, I am very interested in what everyone else is doing. And I get a lot of that feedback now, but I want to see it when everyone knows everything I've endeavored to share. And once that happens and the time effect takes place, because it's going to be a couple years, I know, but I'm relatively young. I'm not an old guy. I'll be 43 this year, but 10 years from now, I hope to still keep getting emails from folks that maybe just discovered me, did the whole thing, and maybe listening to this video here, and changed their life, and by as a byproduct, blessed other people that may not ever even be traders. Okay, but bought them a house. Paid for their child's tuition for college that they couldn't afford. Those are the types of things I want to hear about. Not that, hey man, I went out and bought myself a new Lexus, or I bought a Lamborghini, and I know what it's like to go through 6 mile an hour, 6 mile per gallon fuel consumption. I don't even worry about all that. That's not what I'm worried about. My motivation is I want to see what you're doing to help someone else. Okay, that's really what this is. So it's not egotistical. It's not self, centered. It's really a tithe. I'm giving away of my time and energy because I know it's going to have a blessing way down the line, and it's going to help somebody that will never meet me, and I'm excited about that. And I just want to hear the storylines behind it all before I lay down for the last time. So we're going to go over to the charts, and we're going to look at some of this in a buying scenario because we have mapped it out here on a down scenario or a bearish scenario. Let's take a look at it, what it looks like on a buying opportunity and what this looks like internal. Okay, folks, we are looking at the British pound. This is a daily chart. Now, I know some of you are going to watch this video and assume naturally I'm cherry picking and saying something that happened in hindsight that I didn't call before the fact and yada yada yada. Okay, I'm just going to counsel you to um, trust me when I tell you that I tweeted this whole business down here that we were going to use this for a study scenario, and I tweeted the specific levels and talked about it in great detail in between the time I tweeted it and the time that I commented on it, and now obviously. But we talked about this old low, okay, and a higher time frame level like this particular day. Let's get a better view of it. The low comes in at 146.37. Okay, and I know a lot of you will recognize that level from discussions and tweets and videos that we've shown with it. Let's look at that 146.37. 146.37. So our level is exactly where it needs to be. Now, this penetration of a low, this is a liquidity pool right below this low. It dipped down into a higher level weekly order block. Okay, and I'm not going to spend the time to do that because we've already did that in previous videos. So if you haven't gone through my stuff, there's your reason for having to need to do it. Okay, so trust me when I tell you, we outlined why down here is significantly bullish. We were talking about the likelihood of a bounce in a bear market. Okay, that was the framework for all this. Now, can I look back 6 months from now and say, wow, look at this, I nailed down the low? Maybe, but did I call it the low then? No, I just said it was a bounce in a bear market. I never teach and I never try to trade with the concept of trying to nail down the low because this is ultimately going to, likely, okay, retrace at some degree. And if it does, it takes out this low. Am I calling the low then? No, you don't need the low. You don't need the high, but you just know when it's most likely to trade in a direct, higher lower, and that's all you need. And that's the benefit of having higher time frame charts at your disposal, because the higher time frame charts generally trade in one direction for a length of time that is very conducive for what we're discussing here, high probability setups. Now, a low like this, if it's broken through, you can see the bodies of the candles had a very difficult time moving any degree beyond it lower. But we were anticipating something bullish down here, okay? And again, please look at the videos prior to the time of this video's release, and you'll see that clearly this is all anticipated. Okay, we were looking for a bounce in a bear market, and before we talk about this several hundred pip move up, I want to show you just some of the things that's obviously salient to the discussion here. The move that we see here, see how that took place? It's a rather extended price move. Okay, even the move that took place from this low to this high was extended. Okay, it took some time to unravel. The high up here down to the low in here, it took time for it to establish the high and low price move. Okay, what the point is, once you identify the highest likelihood direction on these higher time frame charts, you want to really focus on that for your high probability setups. Can you buy, in areas like this? Sure you can. But my question is, why would you want to? Especially as a developing trader. You really want to have the odds statistically in your favor. The institutional order flow is bearish here. Okay, and it's not because we're pointing it out in the hindsight, and it's perfect in hindsight, yes, but we were bearish all here. We talked about this gap being filled. Now, it may not appear as a gap on your platform. This gap is there because this platform did not trade during the holidays, but you will see if your chart is not showing the gap, you'll see a big range. Well, the same thing is there. You have a liquidity void that has to come back up in and fill it, and that's exactly what it did here. Okay, so we were anticipating a bounce there, and it come up to where we anticipated, up to this bearish order block, boom, filled the gap, and then boom, lower. Okay, so that's the benefit of having the higher time frame charts at your disposal and understanding what it's doing off of key levels and monthly, weekly, and daily order blocks and liquidity pools. When it was down here, okay, there were several areas of uh, opportunities for price to most likely want to reach for in a down market. We have these highs in here, which at the time of me discussing it said that these are most likely the highs that would be traded to, okay, to reach for any stops above it, because the liquidity outside this range here would only be in this area here. And then we have this spike high here. Okay, so we'll note that. And for this discussion, they don't need to be so precise. It'll still give us the main concepts as it relates to what we're discussing. We have the major low here, liquidity pool. Liquidity pools above these highs here, and a liquidity pool above these highs here. Okay, basically stops. That's the easiest way of describing it. Why would we anticipate stops above this high and above these highs here? Because prior to where it's at now, the market was going lower. Stops would be above this high, and as the price broke down lower, stops would be lower to this point. And then as the market make it lower, they would put stops above this high, protecting their short position. Well, when it's going to bounce, it's going to seek those areas of liquidity. Okay, and you see that happening here. Price runs up, runs that first level around that 150 level here. Boom, those stops are gone. The next level will be around that 151.50. What is that? 151.66. Okay, price runs up through it. Boom, there it is. That was last week. Cleared it out. Okay, the area at which would be next consideration for ultimately, inside this range would be this bullish candle, which is the bearish order block. We would be looking for the 154.60, 154.50 area, okay, in that price range. And again, that's assuming that we blow all the way up to that price point. And if we do that, we probably may have factored in the first part of the year's low, and that may be pretty cool going into the fall. But nonetheless, when price was down here and we were calling for bullish prices, until we get to these levels here, okay, that means the range that's depicted from this level here and this level here, we would anticipate what taking place? Range expansion to the upside. Now, what's the benefit of that? Well, describing what we just talked about as it relates to mapping out the internal market flow, okay, not flow like breaking highs and lows that it's commonly talked about as market flow. I'm talking about the institutional market flow, the order flow. Okay, it's going to be the opening, a down move. They're going to seek value. It'll be undervalued. They're going to accumulate and buy. The range expansion will be the upside. The close will be above the opening price. It's an up day, okay, or it will be an accumulation day. If these levels are taken out, okay, the next level would be here. Stops would be above that level, okay. That means inside this area, all between here, as long as this level is not taken out, okay, we are in a bounce in a bear market. Now we have a swing low here. Now this level becomes influential, okay. So if this low, because we have a swing low here, we have a daily low that's higher than this low and a higher low on this side. Okay, so we have a swing low. I only require 3 candles. I do not need 5 to make what was deemed a MT4 fractal high or low. I don't need 5 candles for that. Larry Williams taught turning points occur at 3 candles, and 3 candles is all it requires. If you look at every turning point, it's there. Now I'm going to get arguments and say, oh, you don't know if it's going to really. Yeah, you're right. I don't know, and you don't know, and we all trade with a level of uncertainty, and I'm okay with that level of uncertainty. I know what I'm looking at in terms of key levels. So again, you get to where I am, and then you'll trust it too. And I don't mean that to be arrogant, but trust me, you only need 3 candles to make a swing high or low, period. So now, looking at what we have here, we've mapped out, okay, an area at which prior, like when it's down here, when it makes the swing low right there, boom, we are seeing the reaction initially that you would expect. Price is trying to move away. where's it going to go? It's going to go to this level here. Why? Because there's going to be buy stops above it, and there's going to be buy stops above it here. For those that have been short, the market's going to seek that liquidity. So now we would look for the open Judas swing down in London, making the low in London between 2 o'clock and 4 o'clock New York time, and then rallying up, then a small retracement between 5 o'clock in the morning and 7 o'clock in the morning, creating a New York session setup. And we would continuously do that until we see a low violated. We don't see any lows violated. It just keeps pressing higher and higher, and then last Friday, boom, we cleared out this high here. Okay, so now watch what we do. We're going to drop down into an hourly chart, and we'll look at the market a little bit more specific. Okay, and now we're going to add the day dividers. So we're looking at basically 2 weeks price action. Okay, 2 weeks of price action, and we see the swing low here, very easily discerned here now. And price does what? Here's Monday's trading between this vertical day and vertical line, this vertical line. This is all Monday's trading. Look what happens. We open, we trade down, make the low of the day, rallies off. We open, drop down, make the low of the day, rally off. Here's another day. Look at this. This is Wednesday. We open, Judas swing down, rally off. Look at Thursday. We open, decline, rally off. Here, same thing. We open, decline a little bit, rally off. So every single day, institutional order flow kept us on the right side. We are looking for where the institutions are going to want to pair orders at. These levels are where the stops are going to be. Look at the reaction once it cleared the first level. Cleared it and then retraced deeper. Okay, comes back up, blows through it, takes out this high, and then finds some support at that same area of where we'd anticipate order flow. So now those buy stops, okay, that were generated, they collapsed. The longs here that they took, their buy orders appear to be on the form of bears that want to protect their short position. Those buy stops are they're going to activate and go active for market orders to buy at the market. Who's going to sell it to them? The smart money that bought it down here. They bought it here. They're selling it to the buy stops here. Okay, so now they run it here. Boom. One more time. But now watch what happens when it comes down here. This same area now will become sensitive. Okay, it'll become sensitive because it was an area of old order flow back here. So now they'll reclaim or recapitalize, okay, this area in the form of something like an order block, if you will. Okay, and this area will provide now support. So old areas of order flow can reverse their role. It becomes an inversion level like in support resistance. Okay, when it rallies up, where's it going to reach for? The next level of order flow and liquidity. So the void, I'm sorry, the liquidity pool that's above this level here has now been absorbed initially. Okay, I expected to go a little bit higher going into this week, but nonetheless, the area at which it trades to, that's what we're looking at. So when it's a buy down here, okay, we're aiming, in our mind, we're anticipating price getting to this level right here. Okay, we want to clean that high. Boom, and you see it right there. Okay, if price continues and finds continued buying pressure and it does not break down, this would be the area at which order flow would reach for next, because liquidity is above these levels. Why? These levels are higher time frame price chart levels, key support resistance levels, liquidity pools. It's just like that. Okay, it's just like that. You just look at areas at which price is going to pull it from here to here. This is how you trade with institutional order flow. It keeps you on the right side of the marketplace, and it shows you where price is going. Now, let's go back to old school market flow. Okay, market flow, here's a swing high. Okay, see that? Price breaks it right there. Boom, it's going higher. Okay, on an hourly chart, swing low. Well, price breaks it here. It's not until you see this high here broken that it's become bullish again, because on an hourly chart, that's the way it is. You're shifting gears all over the place if you're just a market flow type trader. But watch what happens. If you see when market flow is broken, okay, and market structure is suggesting that higher prices are in order, we have this swing high here broken, which is much more significant in my opinion. Price comes back down into what? An old bullish order block. Let's zoom in here. We talked about this, I think, in the last video I produced prior to this one, where we showed what real dynamic support and resistance is, because there's a lot of questions I get about some so-called DSR indicator, but this is really what you're looking for. The down candle prior to the move up is the bullish order block. It's the top of the body's candle and the wick. That is the range at which you want to view the real buying and selling. Okay, well, the buying in this case here. And you can see it comes right down into it there. Bang, nails it. Now, wouldn't you know it, if we go to our fib and go back to baby pips days where I was just giving you the fib tool, there's your optimal trade entry at the sweet spot. Boom. And you thought I was just making this stuff up as I was going along. The point is once we see this, okay, and we understand that we want to see the opening price at this point here. It's this day here. Okay, opening price below it. Well, below it, how far? Well, let's look at that. Okay, here's the opening price, or thereabouts, close to it. Okay, here is 30 pips from the opening at 0 GMT. And that's what these vertical lines are here. Okay, see that? 30 pips from the opening price at 0 GMT. Now we're going to zoom in. Okay, and we're going to go to, here is a new day. Let me make sure I can see my times. I want to make sure I'm showing to you accurately. Here's 5 GMT. Here's the opening price. And right there's 30 pips. The low comes in at 50. Okay, that's Tuesday's low, and that's the one time that you're going to have a loss. Okay, if you're just looking at buying on a limit 30 pips below the opening price. But that's the first filter. Remember what we were talking about before? You have to look at 30 pips below the opening price, and then in that area, and let's map that out. Here's 30 pips right there. Okay, so from the opening price here in the midnight candle in New York time, here's the opening down 30 pips. Then you go left from that price point. That price point. Is there an order block down there? No. Where's the order block? Down here. Okay, so this is the benefit of seeing it when it's live. So you got to go and find out where that order block would be, or liquidity pool, like it did here. Okay, we went down to an area that's bullish. That's what this level is. Here's an old daily low. Price opened up on that Monday and traded down to violate this low. If we look at the candle on that particular day, here's the opening price here, and it come in at, oh, there you go. I mean, we never even came back down to that. Okay, so if you were buying 30 pips below it and then having a stop below it of 30 pips, that would be wonderful. It would be a really good setup. But I'm going to try to teach you to only be trading on Tuesdays and Wednesdays, and try to avoid Mondays. You'll miss a lot of really good opportunities like it did here, but just let it go. Okay, so I lost my line. I should have kept that. I'm sorry. All right, so we have 5 GMT here, and 30 pips below the low is here. So if we were looking at buying down here, there's nothing really to frame the idea. Down here, it is. Okay, so I kind of want to believe that you would have the insight now, especially now, going forward, that you can't really frame the trade here because there's no order block until you get down lower. Okay, so you would have to expect or demand price to get down to that price point. Okay, or at least here. Now let's just say for argument that you didn't follow the rules and you wanted to go long here at this price point. Well, if that's your entry, 30 pips below it from your entry point, price point because you're using a 30 pip stop. Did you get stopped out? No. But if you were looking at like a limit order trader, uh, if you're starting out new, you probably would have messed this up somehow. Okay, and I'll just leave it at that, and you would have seen this later on and probably say, man, it would have been great if I would have been in it, but missed it because of something. Okay, maybe you wouldn't have trusted it going down that low. Maybe you would have thought, well, Michael said it's got to be 30 pips and such. And there's going to be times when you do that. You're going to question me. You're going to question your own understanding, and that's all part of it, guys. All right, so now we have, okay, we just talked about Monday and Tuesday, so now we're going to look at Tuesday's trading in here, okay? We talked and showed in, let me see, is it Market Maker 8, where old order blocks on the other side of the Market Maker profile, okay, or they'll be reclaimed order blocks, okay? This is a small little bounce in the overall buy program or buy profile. This right here, okay, if you use this down candle prior to this move up, watch what happens. Boom, okay. It does not go down to what you would deem classic support and resistance. This is the reason why everyone gets frustrated with support and resistance. They'll say, oh, support and resistance doesn't work. It works wonderful. You just don't know how to use it. Price does not get down to that price point. Here's the high that would be the old resistance, now expected to be turned support. It doesn't get down there. Why? Because it doesn't have to. Here's the order block prior to this little move up. Now, why is this little move up even significant? Watch. We have a consolidation, a breakdown, a return to that consolidation, and a run to support. Smart money reversal, low risk buy, reaccumulation, boom, distribution above the consolidation. There's your market maker buy profile. Okay, we actually mapped all this stuff out, and you see it now in hindsight, but it was all explained step by step by step. And what you do with these points over here, because you're anticipating what? The price is consolidating above a higher level support level or weekly order block. Price comes down, trades into that, and also an old low, or old daily low. This is what this level here is, that 146.37 from the daily chart. But notice what they're doing. They're buying here early because they're hedging in. They have deep pockets. They can do it. You can't do it like this, but they do. So they're buying here. Okay, it drips down into a lower area. They buy more. And it drops even more, and they buy more. It comes on the other side of the market maker buy profile. They're buying a lot here. Boom. Why is it coming back to this price point? It doesn't even give you what you would classically see as, well, Michael, it's not an optimal trade entry. It only goes down to the 50 level. You're right, because that's not what it is. You got to look at where they actually did the buying. The buying is here inside of the buy profile. Okay, they bought here. When it gets back down to it again, they're going to add more buying into it right there. Okay, you see that? So now, and we understand also this is a key low. So watch what we do. If you anchor your price point of your fib on the higher level daily low, okay, we just fall hair shy of the 62% retracement level. But if we, no, I'm probably going to go, yeah, let's just do it. The let's not use that though. Let's use a horizontal line. Inside all this consolidation, okay, all this consolidation, we learned in the Market Maker series that there are levels to look for institutional pricing. Institutional pricing is where you see where all of the orders are collectively working around, and there's a lot of bodies and wicks touching it, okay? And it needs to be rounded to the nearest round number. Inside that range is 156.50. If you anchor your fib, and I know this seems like voodoo, but trust me, over time when you do it, you'll see it's amazing. You fall right down inside of the 62% chase level. But more importantly, look at the bodies of the candle. They're respecting 62 based on that range from the high here and the 50 level here. Why is 50 important? Because it's a significant mid-figure number. It's a high psychological number, and also it's inside the range of this consolidation. And there's a lot of touches and bodies of that candle in that area. Okay, so a little extra for the video, not necessary, but nonetheless, it's there you go. You get more for your money. In here, we have, let's see where we at. 5 GMT, and let's look at that as it relates to buying it. Here's 5 GMT. The opening price is right there, and I'm just ballparking it. And here is 30 pips right there. Okay, looking to be a buyer around there. Okay, but the order block is over here. So you have to use, and then I'm just going to raise this horizontal line up to that price point right there at the top of the body's candle, and as early as the top of the candle's wick. So anywhere in here, that would be a good area, and that would be an area at which you would be buying. Assuming you were not following the rules and you just want to be a buyer down here, okay, 30 pips below that price point is here, you would never gotten stopped out. So are we still holding fast to a 90% likelihood? Well, let's say you missed it here for whatever reason and you don't trade on Mondays. Boom. Did it get from this area, which you would be buying if you didn't follow the rules, but if you did follow the rules down here, you would use this candle here, adding the spread, because you gotta have to factor that in. From that price point, right there is 30 pips from your entry, okay? 60 pips right there. 90 pips right there. Okay. Now, it continued further, but this is all you would do for 3 to 1. But when you're first starting out, that's it right there. Now, does that seem doable? It doesn't seem like you're trying to climb mountains, right? But that's all you need to get 1 to 1. Do that for about a month. And when you're consistently able to do that, learn to trust it and hold it for 2 to 1, and that's right here. And then sit and watch. Does price continue on the rest of the day? And many times you're going to see it does. And then do that for a month. Once you're consistent and you're comfortable with it, hold it for 3 to 1. There's your 90 pips. Okay. Going step, and this is all just in one day. Okay. Ultimately, if you look at where it went to, if you're looking at institutional order flow, you're looking at 342 pips. Now, my question is this: how often have you seen 11 to 1 reward to risk trades in your trading? Get what I'm getting at now? Okay, think about what I'm teaching. I'm teaching you how to trade with the highest level degree of accuracy, knowing when to trade, why to trade it, why it works, using institutional order flow, anticipating the turns because of the market maker profiles with higher level time frame, key support resistance levels, and order blocks, which is all the framework of all this business down here. Okay, and looking for a price reaching to these levels. Now, it even goes higher still. If you're a position trader, here you go, 480 pips. And you risked initially 30. I can tell you that this is not a fluke instance. It doesn't just happen once in a while. Okay, it happens a lot. But now let's go down into a 15-minute time frame, and we'll incorporate that New York session information and why that was even brought up. Okay. I'm probably going to have to lose the colors. Or I mean, I'm sorry, the lines, the levels, to accomplish this. Give me a second here while I think about it. Yeah, if I add that indicator, it's going to give me. Let me see here. I don't want to lose my. Yeah, that's not doing it for me. You're going to get a rough cut on this video. There's a lot of editing that I'm just not going to worry with, and this is part of it. So there, deal with it. The what we'll do is create this. Um, yeah, here's 7 GMT or 2 o'clock in the morning, and 3 o'clock in the morning right there. 1 o'clock to, what am I doing here? Yeah. Okay, between 7 and 9 GMT or 2 o'clock to 4 o'clock in the morning. You're going to see generally the low form. And let's test this out. There's your low. See that? Now a lot of you are saying, oh, that's just one day. All right, here is 2 o'clock in the morning to 4 o'clock in the morning. Let's borrow this level here. Oh, it's an equal low here, so, but this is the end of that range of time, and here's your low. Boom. Okay. And rallies off. You can click, obviously I can beat this dead for a long time and still arrive at no greater explanation as what I showed you in terms of the London session. But let's look at New York, and this is kind of like a real quick revisiting of my YouTube channel video that I put up and reloaded then. It was actually done earlier than that, teaching how to trade the New York session. And what you do is you look for the range between 12 GMT. Really, it's 11:30 GMT, but I'm just going to tell you 12 is a good ballpark number, to 15 GMT. Okay, there you go. And what you do is you anticipate that retracement at which you see there's your New York kill zone and the retracement here, and the time at which we said that the retracement would occur was, and how I'm doing this to give you time, if you watch down here in this little area down here, down below in your MT4 platform, it tells you times, and I just find an area at which it lines up for 12 GMT in the area. Okay, here's 10 GMT actually, because it's 5 a.m. 10 GMT to 12 GMT in that area and time, you're going to see a retracement. We said as late as 8, and that'll be 13 GMT. Okay, and here's where that retracement takes place. See how it starts off and it comes down and into a time at which the New York session kill zone would take place. All right, now looking at the second week of this block of price action we discussed, this order block here, this order block here is a liquidity pool, which is being noted with this higher time frame level. The next one would be up here. Okay, so as price comes back down into it, we find some support. This is the area at which we look for the order blocks to form. Okay, as price comes down, it reacts and comes right back down to a previous down candle, body of the candle, order block 101, boom, takes off and rallies. Okay, up to the next area of liquidity. The Sunday and then Monday's trading, we don't do anything with Sunday and Monday. The opening price, okay, on this day here, this is midnight candle here. We look 30, good grief, 30 pips below the opening price. Okay, at that price point, we look over here. Is there any order blocks that we would use to constitute a buy? Well, think about it. We're on the buy side, okay, but prior to them dropping down, they got to sell it here. So there's some there's sell orders here. They sold into this to take some profits. Okay. As the price moves up, there may be some open float on their short position because again, they don't trade with stops. Smart money's in the market always. They're always in the market. So when price um, is in here short, maybe they sold more than they could get off at a lower price down here. So now they sitting with a losing position here. Once this candle took off, there's a net losing position being held right here. Well, this is when the order block becomes a mitigation block, and kind of think of it as like support and resistance. It really is. I mean, but this is the finest format to view it. So we have an old high here. Price breaks through it. Okay, price comes back down to the first return of that level. First return is going to be sensitive. Okay, price comes down to it, and then we would anticipate what price action taking off, rallying. Okay, so you could be a buyer at this price level here, right there, using a 30 pip stop. You're below it right there. Okay, boom, takes off. Now at this level, if we go down to a 15-minute time frame, okay, we have price making a run here. We can now look at the New York session again because this is what we anticipate. Price starts to rally up in London, okay, and takes its move here, rallies up. We use the body of the candle, the down candle, and the top of the wick, and we're just going to use this horizontal line here to note that right there. And what I did was I highlighted the body of the candle, the top or the opening price, and the high. Okay, you guys want zones? This is a zone, okay, that is dynamic. It's not the stuff underneath the candles, okay? Unless you're looking for a stop rate, then it's useful, okay? But that's not going to require a range. This is going to take out the low. If you're looking for dynamic support, you can utilize the concept of my order block, and it's from the body's candle. On a down candle, it's the opening price and the high. And you can see beautiful illustration of that here. And again, it's not cherry picking. If you look at major support and resistance plays where the market had strong reactions, you'll see a lot of this happening all the time. It's just repeats all the time. It's so generic. It's there always. And here's your 79 cent retracement level. Just went by it by 2-3 pips, but ultimately, boom, takes off. Now, the candle, the time of this candle here, and they're both equal wick, by the way. I mean, they're just right on. Okay, it is 13:15 GMT. That is the New York session. Okay, so are we seeing the reverse of what we showed earlier in the crude depiction of what the internals look like on institutional order flow? Just reversed? Sure we are. You see the low, it rallies off, then comes back and retraces. Okay, what time is this candle here making the high? 12:30 GMT. The candle here, 12:15 GMT. The retracement, and we're looking for the high. In other words, we're looking for a high in this time of day to take place to retrace back into an area at which you can buy that in the range that was created for London. So the low here, the high that was formed in the beginning of the New York session. Okay, and it can go as late as what time? Remember, 13 GMT, which is 8 a.m. New York time. It retraces. Here's 13:15 GMT. So if you really want to be accurate, you can say I was off by 15 minutes there. So there you go. I was wrong. Okay, but the order block is down here. Boom. Most people would be awake and alert during New York session. And let's assume for a moment you use the highest possible area at which to be buying. It's the top of that order block right there. 30 pips is down here, and you're never getting stopped out with that. And then boom, take off. If you were buying there and looking to take your first profit at 30, all you're doing is getting out there. And you don't even need to break the range. There's 30 pips. Okay, and 2-to-1 payout would be here. and 3-to-1 payout is right there, and it still went a little bit higher for that day. Okay, so again, I'm counseling you to go through your charts and study with this mindset. Okay, don't go into it thinking that you got to look for every signal. Don't think that you have to hit 100 pips a week. Okay, just start small, looking for 30 pips, 1-to-1. Frame the understanding you have there and build on it as a foundation, and then learn to expect 2-to-1 payouts. Okay, now I'm going to close it with this. We have this area of price action outlined. Okay, it's basically the last 2 weeks. I'm going to clear this off and just simply do this with the ICT kill zones, and you can see the this little orange section here, that is 1500 to 1600 GMT. I'm going to close this area to what I gave you in terms of the end of the day, and we're going to look at that in such a way where it shows it being 1900 and 1500 GMT. Okay, so what I'm showing you is this will be in this range of up days. Okay, inside of the orange portion, or I guess it's red, I'm not sure, I'm colorblind, good grief. The area, if we look at that, we are saying essentially that this will be the high or low of the day generally on up days. So I wasted my time doing it on that day, sorry. There's that. And in other words, you would look to hold it no longer than this, is what I'm suggesting here by doing this on the up days. And in between the two vertical lines is what we're stating is the highest probable exit point in terms of time. Remember, we use that battery analogy. And you can see it does give you pretty much the highest high, or the optimal area at which to exit. Let me get this off. Take the period separator off because that is not necessary for what I'm showing. And we'll do one more just for completeness. Okay, so what I'm showing here is the blue line area is my ICT kill zone for London. Green is New York, and this is where you want to be getting out for the high of the day if you're buying. And if it's a down day, you'll be looking to get out during this time period for covering your shorts on a down day. Okay, but since we've mapped out an area which buying is the most appropriate form of trading, you'd be buying during the period at which it's blue, and you can see here, buying it, buying it, buying it, buying it. This is a down day, retracing. Okay, we don't trade Mondays anyway. Tuesday, you want to be buying it during the blue period here, exiting. I don't know why I didn't. There you go. You want to be exiting between the two vertical lines here. Here's the high of the day. You want to be buying in the blue area here, buying into an order block, rallies up, and you just a little bit off here. Okay, a couple hours off, but New York session market reversal, which I'll counsel you to look at. I have a video on that. Buying in the blue area, buying it, exiting during this window of time. Okay, the blue area here, buying it, getting out. Between these two periods here, and you're now on the high of the day. It went just a little bit above it, but nonetheless, who's going to complain about that? So I'm going to leave you with this. We talked about the idea of using the higher time frame charts, using the areas of liquidity, looking for order blocks, trading inside the ranges, liquidity voids, where the higher time frame daily charts, pulling price, and I'll counsel you look at the weekly and monthly in the same respect. Where those three higher time frame charts are pulling price will help you trade on a 4-hour chart with no problem at all. And by utilizing those higher time frame charts where price is being pulled, okay, on these higher time frame charts, it will give you the insight that you need to have, because that's exactly how large institutional traders are trading. They're not looking at 5-minute charts. They could care less what the 5-minute chart's doing because they're trading on valuation of price, old order flow. Okay, they're seeing that on the higher time frame charts. They're not looking at 1-minute charts. They're not looking at 5-minute charts. Bottom line is that they're staying on these higher time frames because they need those higher time frame charts to worry about entering in early and exiting early. Because think about it, a whale is a whale. Okay, they just can't turn on a dime. It takes a little bit of effort and time for them to get changed around in a different direction. Whereas I or you swimming in a pool, we could stop, turn around on a dime, and go the other way. They don't have the luxury of doing that. They need all this extra liquidity, okay, that we don't require because we're too small fry. Okay, so um, I'll leave it up to you guys if you believe I was able to deliver in the topics title here. But I can counsel you to do this. Go through this video about 10 times, okay? Because I'm guaranteeing you, if you didn't write down the notes and really studied it, if you watch it 10 times and you write down the notes and you go through it and you start studying it, you will see all the things I just discussed here happening always in the charts. It's there always. And by understanding how we utilize all that stuff, it'll help you move closer and closer to that goal of 90% setups. Until then, guys, um, when we visit each other once again in video, I wish you good luck and good trading.